And good morning to those on the West Coast. Good afternoon to those on the East Coast. My name is Michael Filighera, and I am going to be also presenting today. But I want to talk about how the nature's law is intertwined and supports and creates much of what we do within Elliott Wave and Fibonacci. So understanding that law and accepting that law makes it much easier to read the waves, find the waves, track the waves, and also understand what's behind each particular wave. So where I want to start today is basically just to kind of give you what R.N. Elliott wrote in 1936 or 37 as he was forming and realizing patterns within the stock market back then. Today, it's in all markets. So he chose the stock market to begin with. And so give a little bit of history there. His introduction that he gave to his book, which is called Nature's Law, it was called Rhythm in Nature. So I'm just going to read a little bit from there and then how that applies to what I'm wanting to discuss today. So no truth meets more general acceptance than the universe is ruled by law. So without law, it is self-evident there would be chaos, and where chaos is, nothing is. So all work in dealing with things animate and things inanimate are under the law, because nature itself works in this way. So even though we may not understand the cause or the underlying, or the cause of the underlying or of a particular move, but we can, by observation, predict that move's reoccurrence. So, for example, thousands of years ago, the sun was expected to recurrently rise at a fixed time each day. So, but it took thousands of years before people and human beings realized that there was a cycle there, that there was a reason, that there was something behind it. So we can go on from there and just kind of go on and on about how that order has always been accepted and used, but never really applied to other than like spring plantings, the seasons, the cycle of the moon, the cycle of the day to night and back to day, et cetera, et cetera. So understanding all this, we need to realize that human beings are no less natural. They're no less a natural object than the sun or the moon. And our actions, too, in their metrical occurrence, are subject to analysis. Human activities, while amazing in character if approached from a rhythmical bias, contain a precise and natural answer to some of our most perplexing problems. Furthermore, because humans are subject to rhythmical procedure, calculations having to do with our activities can be projected far into the future with a justification and a certainty that was never unattainable before. And what he's referring to here is through the use of Elliott and the use of Fibonacci, we can start looking beyond where markets have traded to find levels and to understand where a particular move, a particular bull market or bear market may reach. So now, having said all of that, I want to just really kind of go into Fibonacci. So I will give a real quick basic look at Elliott, but let me just kind of lay out some of the Fibonacci. So Fibonacci was an Italian mathematician who lived during the 13th century. So in his day, he was known as Leonardo da Pisa because that's where he was from. He was from Pisa, Italy. But he visited Egypt and Greece, and on his return to Italy, disclosed what is now known as a summation series. And that series of numbers is as follows: 1, 2, 3, 5, 8, 13, 21, 34, 55, 89, 144, and on to infinity. So basically what it is that you're taking the number one, you're adding one, and that's two. When you add 2 to 1, that's 3. When you add 3 to 2, it's 5, etc. So you can see how the summation is put together. So any two adjoining numbers equal the next higher number. Any number divided by the next higher number gives a ratio of 0.618. So for example, 8 divided by 13 equals 0.618. So any number divided by the next lower number gives a reciprocal of 1.618. In the lower numbers, the ratios are not exact, but close enough for our purposes. So to simplify, many times you'll hear the analyst, or even me, you'll hear when I'm using that, I will say instead of 0.618, I will say 62% versus 0.618%, et cetera, et cetera. So 0.382, I usually leave it there, but they may round it up to 40. So getting that, I am not showing slides. I don't use slides. I use a live market, and I'll be going over to that live market very quickly here. So one thing that Elliott did is he went and he did a search of the yes, that's correct. That's the screen that I'm showing. I'll be over there in just a second, and we're going to go over the Elliott, and we're going to go over some different things. But I just want to lay some of the background so that we can see what and how Fibonacci is really putting it together. So what we need to understand is that Elliott wave, or the Elliott wave theory, is based on building blocks. So I'm going to go out real quick. Let's go to my weekly chart. And I've got a bunch of stuff on this that I need to just take off so that we can see things. So Elliott's premise was that whatever we're counting in this particular case, he used the stock market, so we're going to use equity markets right now, that they move in impulse waves, which he labeled 1, 2, 3, 4, 5. And wave 2 corrected wave 1. So this correction was correcting that rally. Wave 4 corrects wave 3. So that was corrected by this. And then when wave 5 is complete, the entire movement is then corrected by 3 waves labeled A, B, C. Now, the premise is that those form building blocks. And what I mean by that is that Elliott also said that once we get that complete movement, which is going to be a total of 8 waves, 5 on the impulse, 3 in the corrective, equal 8, that then forms the first and second wave of 1 degree higher. So this is not the best example because this was at the end of a move. But if we were to go, let's see if I can find one so I can see it a little bit clearer. Well, this one actually, we can see 1, 2, 3, 4, and that's not labeled correctly. This should be 3 up here, and that's a 4, and that's a 5. So sorry about that. And then we got a 3-wave rally, and that was the correction, and that was the 3 waves. Now this is no wrong. Please excuse me while I go in and just change this so that I'm able to read my own labeling. I didn't realize that chart was all screwed up like it was. And let me just change that. So now I'm going to be able to do this correctly. So we have 1, 2, 3, 4, 5, and then we have an A, B, and a C. So there, and that then, and its total completed a much larger move. But I wanted to just basically show you 5 waves down or 5 waves up is followed by a 3-wave correction, and depending on the direction. So building blocks is a very important concept to try to understand, because degrees you're going to hear an Elliottician talk about all the time. And for example, back in November of 2021, the NASDAQ completed a very long-term bull market or bull phase or wave sequence higher. So impulse sequences. And so during that whole process, the market unfolded in 5 waves. And from the low, and so this is where I'm going to go back to. So this is a monthly maximum chart on the future. And this is the dot-com bust. So when the dot-com gave it up, the NASDAQ lost 89% of its value, dropped to 719, and that was from 4,800. And let's see, come on, give me that. 48.84. So it went from 48.84 all the way down to 719, I think it was. Low 835, sorry. So that then was a cycle degree move. And what we then look for is a cycle 5 advance. Now, we need to then break that down, building blocks, remember, that within the cycle degree, we need to then focus on March of 2020. Yes, it did. You're right. So, but on the cycle degree, we now need to work back down and we need to understand what's going to be inside that cycle degree. Well, we know because how the cycles form going up, we can go from minor, which is going to be the saddle brown color, to intermediate, which is the next level up, that's yellow, to primary, which is labeled in green, to cycle, which is labeled in red. So what's going to be in that cycle degree 5th wave? 5 waves of primary degree. So there's 1, 2, there's 3, there's 4, and there's 5 kind of buried underneath there because I scrunched it together. Now, when we come down and go, well, what's going to be in that primary 1st wave? 5 waves of intermediate degree, which again are kind of all shifted together here because we're condensing all this time, shoving it together. But there are 5 waves of intermediate degree. So then what's then we're going to have after we finish the 5 waves of primary degree and the 5 waves of the 5 waves of intermediate degree to label primary wave 1, we then have an ABC correction and of intermediate degree to form primary wave 2. Now we can break it down further, again, monthly maximum charts. You're going to have to break it going deeper in or shorter term. There's likely, I believe this was a 5 wave A. So it's 5 waves down, produces wave A, 3 waves to produce B, 5 waves to produce C. So when we're building on Elliott, as we go step by step, we realize that impulse waves consist of 5 waves. Again, 1, 2, 3, and they're labeled 1, 2, 3, 4, 5. No matter what the degree, it's still going to consist of those 5 waves. As terms of with the understanding. So waves 1, 3, and 5 within that structure are going to be the impulse. They will each consist of their own 5 waves. So depending on the degree that we're labeling, then we're going to know that labeling down where we're going to be looking for those 5 waves. And then again, it repeats. So in other words, within this, well, let's actually go up a little bit. Now we're going to go to the primary 3rd wave. What's inside of that? 5 waves of intermediate degree. Once again, right? Same as there. Well, there's 1, 2, 3, 4, 5. But guess what happens inside that 3rd? It subdivides. It extends. So part of what Elliott was talking about was that we have a 5 wave impulse. Wave 1, 3, and 5 are in the direction of the trend. Wave 2 corrects 1. Wave 4 corrects 3. Wave 3 is most often the longest and the strongest out of that 5-wave sequence. And usually why? Because, well, it's the center, that's number one, but it will subdivide. So all of our subsequent sequences within 1, 3, and 5, they will also subdivide into their own 5 waves of lesser degree. In this case, we had the minor degree, very trackable, and put the labeling on, but within it, the third again subdivided within itself. And that is the extension. So the third waves are normally the longest and the strongest. Rule number 1, third waves can never be the shortest wave out of waves 1, 3, and 5. Does not always have to be the longest, but it cannot be the shortest. That's one rule. Another rule that we have to embrace and accept is that wave 4 can never overlap the price territory of wave 1. In this case, not a chance. But there are times when you'll get close on a smaller degree, and then it won't work. And you don't break those rules. So there are characteristics and personalities for each of these waves. It behooves us to learn them because they certainly come into play. And why? Well, because the participants are us humans, and human activity is chartable. And so truly what Elliott Wave, I believe, does reveal is the human emotional reactions in a market. When these things come into play, then we get bullish and bearish moves. And when we see certain things take place, it's usually because of an emotional reaction. So keeping that all in mind brings me back to just understanding that we have human activities. It does include things as price changes, so stock prices, bond prices, patents, price of gold, population movements, cities from the cities to the farms and vice versa, commodity prices, government expenditures, everything. These are all included within human activities. And it's those human activities that produce the waves, right? Because what happens when we're in a situation like we are now, where we're having to battle inflation and we have constant threat of higher interest rates, higher interest rates, higher interest rates. Now, unfortunately, at this particular time, many, so at least two generations of traders have never dealt with living or operating in a high inflation period or a period of high inflation. So what can cause that? I'm not really going to go into that conversation today, but realize that everything we did, and I'll show you real quick, everything here, this release of trillions of dollars, which, by the way, was necessary at the time. And we all have to just go back to 2020 when we were told by the government, local, state, and federal, you have to stay home. You no longer can go wandering around. You can't go out. You need to isolate. You need to wear masks. You need to stay off of this. You can't do that. And so what happened was people can't work. How are they supposed to pay their bills, and how are they supposed to provide for the family and put food on the table, et cetera, et cetera, et cetera? So the government had to come out and basically say that they had to pay us because we had to keep the economy going. We had to keep families going. We had to keep life still functioning on whatever level here in the US. So massive amounts of money went to give us the stimulus payments. Massive amounts of money went to corporations so that they could then pay for their employees, pay for acquisitions, et cetera, et cetera, et cetera. So what happened? Cheap money going into the market, boom, you race it. So that in and of itself is inflationary. It just took a while for it to catch up. It just took a while for it to really rear its ugly face, to realize that, hey, Fed, you can no longer keep interest rates as low as they are, because it will throw us into a very, very deep recession and the inability for the government to actually pay its obligations. Now, the only other period that I can really compare this to would be in did January 21 escape a wave? Hold on one second, Matt. I'll be right back with that. January of 21. That's 20. Here we are in 21 here. You mean there? Because it was internal. It's part of wave 3. So I didn't break it down into the minors. But it was all part of the third wave. So back to what I was saying in terms of the last period of really high inflation was the 1981. And that was coming off of the 70s. And unfortunately, a lot of you guys weren't around, and that's not your fault. But that was also a period where we had stalled markets. We had markets that just weren't going to go anywhere. We had a very elongated recessionary inflationary period that lasted all the way up to like 1979. Now, when it was necessary to come back out of that, it became inflationary, getting people back to work. High employment is actually not bad for the people that are getting the jobs, but it is inflationary to the economy. So there's two-edged swords all the way around this. How we deal with it and what we expect, now that is where we have the control. So understanding that in periods of inflation, the way that that's controlled is you must control the money flow. You must control how much money is going out and at what rate. So how do they control that? Well, you raise the interest rates. You take it out of their hands, basically. And so back in 1981, and I would encourage, if you're really looking to get some answers and some realization of what needs to take place, that's the situation that you compare it to. And you can go back and read the works, or any of the works published by Paul Volcker, who was the Fed chair at that time. Yes, extremely high oil prices in the 70s and the oil embargo impacted the economy dramatically. That's really what kicked it off. That's what started it. And trust me, I was alive, and I was actually just got my driver's license when that first started. I remember gas being 25 cents a gallon and suddenly going to $1. Yes, I do remember sitting in lines at the gas station. I'm glad you do as well. So it was not comfortable, and it really was a very confusing period. Now, fast forward, 1981, inflation is just now going crazy. In fact, it was the last time when we reached 9% that it wasn't at 9% was back in this period. So interest rates had to go up. Paul Volcker came out and said, this is what he's going to have to do, but we need to control the inflation and we need to tame it and really bring it back down. And unfortunately, what it took to get there was he had to raise the prime rate, Fed funds rate, to, I believe, between 19 and 21%. Where are we now? 3? 3.5? And people are screaming, that's enough, we don't need to go anymore. I don't think that we really understand. So that's what I'm talking about. A couple of generations that just have no idea. And this generation that also feels like, well, gee, 8 months of correction, that's got to be over. We got to get back. The Fed can start lowering rates again, can't they? No, they can't. Not unless we really want to just go into a tailspin. So in other words, to make it even more of like what we would consider a soft landing, this market needs to correct. What is propelling it right now are inflation. What if I look at it on a Elliott basis? It's completed an intermediate 5, a primary 5th, and a cycle 5th, 5, and a super cycle 3rd wave. So what we're in, oh, and by the way, timing wise, this super cycle 3rd wave began in 1942. And there was no NASDAQ. So I'm relating it in comparison to the S&P, and in the SPX, that cycle 3rd wave began in 1942. Here in the NASDAQ, I have to go back that this cycle 3rd likely began after, I think I want to say 87, after the 87 crash. I think I've got to go, I have it going back that far. In any case, it's a much longer term. This cycle 5th wave, we just realized, began in 2002. So up to that high, that's 19 years. So if anything, we need to correct the last 19 years of rally. So that's kind of bad. Now, on the primary degree, we're correcting back down to the March of 2020 lows. That's where primary 5 began. On this intermediate degree, well, actually, we're just really, well, correcting longer, but primarily back to 14,317, which actually was in September of last year. So now, understanding what the corrections are going to form, right? If we have 5-way structures, those are all the impulses. So this is labeled 5, 5, 5, and a 3, so they're all numerical. The corrective phases in every last one of these comes in 3 waves, right? A, B, C, A, B, C. Everything comes into ABCs, even this primary. So as we work our way lower, all of these, if this, we're looking for a super cycle wave 4, it's going to consist of an ABC of a cycle degree, an ABC of a primary degree, and an ABC decline of an intermediate degree. Now, within these waves, corrective waves can come in 2 forms. Impulse waves, 1. It's 5 waves. That's it. That's what consists of an impulse. Very simple. When we're counting corrective waves, they are counted as ABC, so they're letters versus numbers. And they either can take 2 forms. One is called a zigzag, and that's zigzag. That's what this one was. The other is a flat. And what the flat basically is telling us is the A and the B and the C will likely come within the same range. A wave sets the range, the B wave is within it, and the C wave maybe breaks one side by a little bit as it goes through. And in any case, what we have here is wave A can either be 3 waves or 5. That's what 3 waves forms the flat, 5 waves forms the zigzag. C waves, here's something, it's a rule and always comes into play. C waves are always 5 waves. So when you're labeling and when you're working an account and you're looking at the market, when you know the rules and you understand what you're looking for, it helps you form your count and keep your count. Now, going one step further, each one of these waves has its own personality. And depending on the degree, now you can get an idea how big of a personality that particular wave is going to have. And we're talking like a minor to a minute to a sub-minute level, still going to have the same personality. So we're still expecting certain types of moves within it, but they're going to be in line with the degree of that move. And so, for example, if I'm counting an intermediate degree wave 1 versus a minor wave 1, well, there you can see the size. So think about it this way. When you have tornadoes, they have the F1, 2, 3, and 4, and 5, and an F5 tornado. is devastation from the minute it hits the ground to the minute it dissipates. Just absolutely wipes out entire sections of the country. A hurricane, same deal. Category 1, 2, 3, 4, and 5. Category 5 is Katrina, is Sandy, is all of these big hurricanes that absolutely devastated different parts of our country. Earthquakes, right? 1 point, 2 point, 3 point, 4, 5, 6, 7, 8, 9. We've got some a little bit over 9. And what they say is that from a 1 to a 2, it's 10 to 100% stronger. Now, bear that in mind as we go up in degrees. I'm looking for a super cycle wave 4 correction. Where and how low could that go? Well, Elliott talks very cleanly about how, well, more often it's going to the 4th wave of supercycle degree should find support, or as Elliott said, its terminus, its endpoint within the price territory of the 4th wave of 1 lesser degree. Supercycle 1 lesser degree is cycle. Let me go back out to that monthly maximum. There is cycle 4. Right? If I go over to the S&P, cycle 4 was the 2009 low. Now, if you're listening to any of my work, anything that I talk about, you're going to see that what I'm making reference to is the 4th wave of 1 lesser degree. And in the S&P, that's 670. I'm going to round it up. In the NASDAQ, it's actually even lower because that cycle low was back in 2002 at 764. Now, price territory gives it a lot more room. And now we're coming up to 49, down to that level. But often, Elliott was making reference to it should come in towards the low. So again, now I'm going to back this all the way back up, taking a look at the weekly chart. I am looking for this initial cycle wave A, right, which is going to consist of a primary degree A, B, and C wave. I'm expecting it to find its terminus, its endpoint, at the low of primary wave 4. And that's actually just going to complete cycle wave A. So this is what I'm talking about. We're in a longer term corrective process. Now, Elliott will never say, oh, because it's going to go down because of this, and that. It's just the wave pattern itself tells us, but it never is going to provide you the reason, what's going to be behind all of these things. So that's an important thing to remember. Now, I called these tops, I counted it out and said, I've started to look for it. And I didn't go whole hog by saying what I was looking for. I mentioned it. And people started responding. Oh my God, no way, can't happen. How could it possibly just go down? And what they're counting on is that people aren't going to give this up. People may have no choice. This was brought about with cheap money. Corporations like Apple, Amazon, borrowed billions at less than 1% interest. It's a great way because they can turn that around. How do I make an entry from what, Steve? From what I'm talking about? Thank you, Donald. Well, the entry is going to be on a couple of things. I'll talk about that right now because you're asking. If you're a swing trader, if you're a position trader, if you're a day trader, that all is going to make a lot of difference on how you want to approach this and where you want to invest and how you want to invest. Don't forget that while the market is going down, day trading, oh my God, then you're making decisions every day. And then you want to listen to, I do daily updates on the S&P and the NASDAQ. And yes, your life will be much, much easier because what I work with, it's the same process. It's the same process, whether I'm on the weekly chart, or I'm going to bring it down to the hourly chart. Guess what? Still letters, what we're doing, and numbers, what we're doing. That's fine. I also can show you how you can get additional funding for an account to trade futures. So I'm going to put this right in here for you now, Steve, so I don't forget. That's my email address. Email me and I will give you more information. So anyway, just to continue, it's the same no matter where we are. And to answer Steve's question, no matter where we are in the cycle, everything follows pattern. Everything follows what my count is telling me. This is very confusing. And now they're going up, which makes it even more confusing. But I say they probably come up to here and then swing lower again. This buying, people have to have a reason. Right now, they're trying to throw it behind Apple, but it's not Apple's not even rallying all that strongly. They're going after additional other stocks. And why? Who knows? Who knows? But when I'm thinking about what's bullish or bearish, I think about that nothing has changed. Has inflation been tamed? Are we suddenly get a report that inflation is actually back down to 5% or it's heading lower? No, but we're going to go on a hope of women and prayer of what Powell will say tomorrow to give us any clue, to give us something. And I think what really, it's human emotional reactions. Remember, if they get a bullish signal from what they think Powell is saying tomorrow morning, you watch what they do. They will storm back in. Why? Because the investing public, retail traders, basically have not learned how to short. They only can buy. And they've got this great idea, buy and hold. Well, we're definitely going to go to new highs. So, but that's not the way it is. So, Steve, to talk with your thoughts of how do I day trade this? I do day trade it. And I bring it down to a 5-minute chart or less. And trust me, let me just say, I'll quickly show you. Here are my trading screens. So guess what? Even down here, Elliott is present and it follows. This was 3 waves down. What comes next? Well, we do another 5 up. This was correction. Here's the rally. Here was the correction. Here's the rally. Here's the correction. Here's the rally. They're just going to go. And then I follow, look at, they're pouring in. They're pouring in money. So it's understanding a bunch of things on how, oh, you guys can't see that because I stopped my share. And let me go back out there and put on my new share, and then I'll go over here so that we can see now. Sorry about that. Now you can see my screen. You see Elliott works all the way around. They're dumping money in. So it's also understanding what kind of takes place during this first to second week of a new month. Well, we got tons of people still with 401ks and IRAs, and they come in at the beginning of the month and they put their allotment into the market. Now, this I think is not a smart way to invest, but who am I? And I'm not going to tell anybody what they should or should not do. But I think there are better ways to put your money to work, but they don't know of a better way. So when I hopefully I fixed that for you and you can see now. So then along with this, you can use, there's a lot of different lines in there and I'm not going to go over those right now. But there are Fibonacci comes into play here. And let me go back over to this guy so that I can just continue. So this 5-minute screen, you can see them. You can count them. 1, 2, 3, 4, 1, 2, 1, 2. This is going to blast. If I had to say, I feel that this could likely blast. Either that, I'd have to be more careful about the count, but you can see larger, that's probably 1, or A, and that can't be an A. It's got to be a 1, a 2, and then it starts to break down into the 3. Maybe the 3 goes up to there, a 4, and the 5. They're not pretty. You have to really understand Elliott. You have to follow the rules so that you can put your labeling down. But you can put in, and I'll do it right away so that you can see how that functions. Fibonacci can be put onto the market during the day. And just see how they're coming up to Fibonacci levels. They've just reached 1.382. So this move has now traveled 1.382% of this move. So if this is A, this is B, and this is a C, well, C waves, I would say it likely isn't going to hold there. This is like where it's going to go. That's the power of Fibonacci. Yeah, it could be maxed out before reversing. You're absolutely correct. But that just seems the way that it all goes. So when you're day trading and you're trying to understand, it's like you've got so many things that you really got to put into focus. We have moving averages, which come into play. We have Fibonacci, which comes into play. We have pivot points. We have volume profiles. Again, those volume profiles are what's evident here. Points of control, value area high, value area low. And I can put those out on a longer term chart, and we can see we're coming up to the session's high, the range, the top of the range, 12,193. We just pushed up to that, and they keep pushing it, and these are the volume profiles. So the point of control is still down there, but it might shift soon. So the majority of volume took place at 12,066 or in this area. Now, what does that point of control actually mean? Point of control just means it's like that's where buyers and sellers can meet. So as a day trader, you constantly want to keep in mind where's the value area. Now, that doesn't mean it's a good buy or it's a good sell. Value, nothing more to me than means that this is where a buyer can find value, and because they have to pay a certain value for where the sellers are going to come in and sell it to them. That's value, not necessarily the direct level. So value areas can be calculated by where the market trades. Right now, value area high is shifted up. This was an extended value area, which got taken out early this morning. And this is value area low, but I'm suspecting that if they continue to rally, this will all shift with it. As the market moves, it shifts. Buyers are in control today, right? And so as they have more needs to buy, sellers are fairly going to go, I got no more to sell here. So they back off, move it up. Well, where can I buy it? Well, I'm up here, and they will go up there and they buy it at the market. So the value area will shift. Understanding that helps you. How does that work with Elliott? Well, it works very cleanly with Elliott when you can understand what type of a wave pattern am I in. If this is an A, remember, I'm on a 5-minute chart. An A, a B, and a C. C waves can be very destructive. Elliott wave measures limits. Not sure what you mean by that. Maybe you can tell me what you mean by limits. Elliott doesn't necessarily measure the limits. Fibonacci gives you an idea, gives you a mathematical process to which you can find where resistance and or support. Yeah. It can help you determine where it can go. And then on top of it, there are relationships, Fibonacci relationships between the waves So right now, if I'm counting an ABC up, then there are relationships between wave C and wave A. And then that's why I run that extension. So these extensions tell me, well, what are the limitations? Well, the most common for wave C to wave A would be 100%. Well, that's super, that blew that one out the door. Well, what's up next? Well, we do have some here, but that you can see they blew that out the door. So really, where's the next point of strength going to come from? 1.618. So once you really pick this up and you can book it and you keep it up in your head, now you're drawing where the market possibly could go. If it continues to go, we very likely will be heading up. I'd have to pull open a different chart. We will be going up to 395. And that is a different fib, but it's still a Fibonacci level. Now, we also have moving averages, which the market will bump into right here at this 2.382, right? So I use, again, you're always going to use variations of 0.382, 0.50, 0.618, 0.786, et cetera, but I can set them up. So my main ones are going to be 0.382, 1.382, 2.382, 618, 1.618, 2.618, but there's only so many I can add before Thinkorswim tells me, got to take one out if you want to add more. And sometimes I will have to. More important right now is to understand that as this comes down, these are the moving averages. This is a 200 period moving average. The solid line is an EMA. The dotted or dash line is an SMA. Both are important, and look what happens. They're both gathered and touching right at 12,346. That would be an ultimate high. So as it starts to break above this 50, which it did a while back, right there, and we start to get the 4, the 8, and the 20 heading up, the 8's getting ready to cross the 50, that's going to throw in another round of people buying. Elliott Wave forecast price limits. I wouldn't put limits. Targets is a better word. It's on YouTube, 343898. It's on YouTube. And so you would go and you would first search traders helping traders. And even though I own that domain, it's been hacked on YouTube. And so others are using it. But you're going to want to go in there, and then you're going to want to search for my name. And I'm going to type that in so that you can get this spelling correct. And my channel right now, I have 2,200 some odd subscribers. So you're going to want to find first Traders Helping Traders, my name, and then I actually have 2 channels. You're going to want to go to the one that's 12,200 subscribers. And every day I go through all of this. I update my situation. That's what I do. So again, that would be something to do. So what I'm really trying to get to today is that once we can become adjusted to accepting, you're welcome, accepting the law of nature. We are human beings. We are subject to that law. Now, think about this. Fibonacci, so the summation sequence, Fibonacci number sequence, it's all over the place. When we think about us as human beings, we're constructed in an Elliott or in a Fibonacci sequence. So our bodies, the numbers 3 and 5 are all over the place. So from our torso, there are 5 projections: head, 2 arms, 2 legs. Each leg and arm is subdivided into 3 sections. Legs and arms terminate in 5 toes and fingers. The toes and fingers, except our big toe, are subdivided into 3 sections. And we have five senses. Now, I want to just bring something to your attention, how our brains are already sequenced and formed around Fibonacci relationships. Yes, that is correct. Fibonacci relationships. For example, our eyes are Fibonacci 0.382 to the center, right? So we're all lined up. Now, not that we're being cruel, but you see somebody and maybe they have a crossed eye or eye that's not, our brain is immediately drawn to it. You immediately look. You're not being rude. You're not attempting to stare. You're not holding it against them. It's just that our brains are not geared to accept something outside of a Fibonacci relationship. Same deal. We're walking down the street. Somebody maybe has lost an arm. Their Fibonacci relationship with their body has now been adjusted. We're going to notice it. Why? Because I don't see the equal. I don't see that relationship in play. The brain isn't putting that together. So we are subject to the rules and the law of nature. If we accept that, then we understand that it's going to be our human emotional reactions that propel any market. Right? And what are the main emotions of any tradable market? Greed and fear. So it's a whole nother conversation of how we deal with fear, how we deal with hesitation, how we deal with the things that we won't be able to do. What holds us back? Why do I over indicatorize a chart to where I have to have all these things? Thank you so much. I hope that you can. And here's the other thing that I will include for you. And I'm sorry, your name's not coming up, but 343-898. Ask questions, comment. I always answer. If you have a question, an Elliott question, a Fibonacci question, I always answer. I'm very strong on I'm here to help teach. I love teaching. I love explaining. I love getting people to a level where they also can just go in and make change to their P&L, to the positive. And Steve, yes, analysis paralysis is real. So how can I kind of wrap this up? I never have enough time. I will get to that. I have, as a student of very long and natural cycle over the course of time, I've been acquainted with some of the geniuses of wave theory, and I must say I have never heard it presented in such an organic yet. Thank you. Thank you. That's the whole purpose. I'm so glad. Thank you for telling me that. That's really great. Third wave, I don't think it's a third wave. It could be. It could be. I do have a wave count that would suggest that this low completed. I got to go back over this way. Let me see if I can get that. See, up here's where I've been putting a primary B wave. You'll see that. And then I'm going to have to end on this. There's primary wave B, but I always have an alternate count or an alternate view or view one, view two, so to speak. And for the longest time, you're very welcome. For the longest time, I was considering this move to be primary A, intermediate wave A of that primary B wave. Then we got this humongous drop that day and follow through and follow through and follow through, which brought it about where because I was thinking if this was intermediate wave A, this would be intermediate wave B of this primary wave B, which would end up way over here, by the way. And then what that would suggest, if that completed intermediate wave B, then we are in an intermediate C wave going up. What would the result be? We're in the very infancy stage right now. The result would be eventually for the market the NASDAQ to go back above 13,741 and likely up into here before we get this absolutely incredible, nasty drop down. This decline that we're going into. So that still remains out there, yet to be determined. I continue to look at it as, okay, it's a primary C wave down, but that continued to suggest that the market should turn and drop like a stone, and it hasn't. It did, and then it stops. And now we're stopping even stronger. So I may have to go back and go, no, it actually was view number 2. And then people say, oh, that's all wishy-washy. But it's like, I tell you what, as a day trader, I'll trade. Even with this view, I'm going to be buying. Why would I sell into this? That would be ridiculous. It really would. You'll blow out your account in a heartbeat. Why would I sell? I play the price action. So there's a difference. I have an Elliott account because that's where my training has been in Elliott. I picked up Elliott and I learned from Robert Prechter and Dan Ascani back in 1988. It has been my core for analysis ever since. It has done so well by me. So I will always have a count. I will always have a picture of what I think these markets will be doing. But in the interim, I'm a day trader. As a position trader, I can show you and help you determine how you want to position yourself for what's coming. As a swing trader, it's a different mindset. So that's another subject that we all need to really take a look at. Having the right mindset to trade how you want to trade is vital. And your mindset cannot be penetratable by noise. And what do I consider noise? All of this. Oh, Apple, good news, go buy Apple. Oh, this is great. Oh, that wasn't so good, sell it. It's garbage and it's noise, and it's going to break your mindset and take you away from price action. Whatever happens in any of these component stocks, you will see via the price action. And if you have your count and you've got your resistance and support, and you're working with, as I showed before, your different levels, you go to town, you work and you trade. Now, I'm going to open it up real quick. Yes, Steve, you're right. And you're welcome, Dominic, because I got to turn this back over to David. We do have the next person coming on. By the way, if you were here and you were listening to Wally prior, I really like Wally's work. It's strong. It's true. I caught the very tail end. I will be at that special presentation he's going to make. His stuff is really good. It's non-biased. He's not really biased, bullish or bearish bias. He totally technical orientated. And unfortunately, because everything is algorithmic and quantitative right now, there's no other way to trade. Yes, fibs are the way to go. Again, I'm just going to time this out. David, you cut me off right away if you need to, but I'm just looking if there's any questions. Either that. Again, I never have enough time. And I'm going to get David one day to just give me 2 hours or even more. So, David, I will turn it back to you because I know we need to get set up for the next person.